Supply and demand is not just a strategy. It is simply the consecutive algorithm that the large institutions use to manipulate price. However, there are many key factors that many traders don't understand about institutional supply and demand. And once you can understand and master these key factors, you will learn how you can trade alongside and in the footprints of the large institutions that manipulates price. How to catch large risk to reward trades, and how you can bank consistent profits. In today's video, I'm going to teach you these key supply and demand factors that you need to understand in order to master supply and demand trading. These specific key points that I'm going to give you in today's video has helped many of my members reach their first ever payouts and become funded. This video will go over what is supply and demand, what is institutional order flow, how to properly draw out institutional supply and demand, and how to enter and exit these institutional zones for maximum profit. But first, to take advantage of price and the markets, you need to understand the real reason behind what moves price. Does price shooting from down here all the way to up here mean there is more buyers than sellers? No, this is wrong. Now keep watching to find out the truth as we dive into this. The millions and billions of dollars that is run through the markets every single day is not because of strategies being SMC, ICT, retail, or fundamentals or news. It's because, as history has shown, a group of traders is a very emotionally driven group of people. Therefore, trading being a very highly emotional money game with a combination of fear, greed, ego, and uncertainty. And their combined behavior takes on an occurred mentality. And we can spot this on our price charts and make money from it. How? Let me break this down for you. Well, you've got a million different market participants putting millions of orders through the markets for a million different reasons. All of this behavior and emotions on participation is what drives order flow in the markets. And this order flow is what prints price action on our charts. And that price action creates patterns on our charts. And these patterns print themselves over and time again. This allows us to create high probability forecasts in where price may move in the future. When those institutions enter trades and positions, they cannot hide their order flow, and we can spot this order flow on our charts in front of us, if you know what to look for. Currency exchange rates move up and down as a result of supply and demand from market speculators. No trades can take place unless both the seller and the buyer can agree on a price. And this is what drives price in currency pairs, crypto, indices, commodities, and futures. Buyers bring in demand for their pair, applying that upward pressure on price. Sellers bring in supply for their pair, applying that downward pressure on price. The market runs like a continuous auction throughout the day, with buyers and sellers continuously competing for price. Now, in a perfect and free market, this would be a fairly simple, smooth, and fair process. But in a financial market, this is often a heavy, manipulated process. Let me explain. The markets work in two-way auctions, both buy and sell side of liquid instruments. Blocks of orders on both the bid and the offers. We can see this visualized through order flow. On the left-hand side, you can see all of the bids from the buyers, and this shows you how much volume is demanded from each price level. On the right-hand side, you can see all of the offers from the sellers, and this shows you how much volume of supply is at each price level, which is also known as the ask price. Now, the more volume there is at each price level, the more liquid the market is. Think of it much like an auction house, eBay or We Buy Cars, where you are the buyer making a bid, or you're the seller making an offer for it, where you're asking someone to pay for it. But remember, that transaction can only take place if both the buyer and the seller exists, and both of them agree on a price. Similarly to the markets, to execute an order, there must be payers with an opposite order of equal size. For example, to sell 8 lots, there must be a buyer willing to buy them at the ask price of 8 lots, and vice versa. And this is how the markets move. Now, what most people don't know is there is two types of orders, where both buyers and sellers can be both passive and or aggressive. Passive traders use limit orders, where they are waiting for price to reach their area of interest for their order to execute. So all of these orders that you see on the bid and the ask are order limits. Therefore, if there were only passive orders, the markets wouldn't move, because all of those orders are waiting to be hit. And this is where aggressive orders come into play. Aggressive buyers and sellers are trading at the current market price, and they are not waiting for the market to come to them. To do that, they have to cross the spread to buy at the ask price, or to cross the spread to sell at the bid price. Most execution platforms look like this, where you buy on the right-hand side, as that is the current ask price, and you must cross that spread to be an aggressive buyer. And on the left-hand side, if you want to sell, you need to cross the spread to hit the bid price. This interplay between the passive and aggressive traders is what we call order flow. Let's take a look at a simplified example of order flow. Let's take a look at a fairly simple example of what would happen in an order book in a live market. Imagine this order book represents the Euro USD, and a large institution wants to buy 10,000 lots at current market price. So this would be an aggressive order. They have to buy 10,000 lots at the best ask price. But as you can see, there's only 281 lots available at that current ask price. So price will rapidly shoot up as it instantly absorbs all of the supply at that particular level until the point all 10,000 lots have been fulfilled at 1.1527 due to that huge imbalance between supply and demand. So now the market is sitting at what we deem to be called fair value between buyers and sellers. So the market needs to keep moving up to seek liquidity to fill the order. So institutions cannot hide that huge imbalance that they cause in the markets. So if you know how to spot their footprints in the chart, then you will be able to trade alongside their order flow without getting smashed by them. So what does this look like on a candlestick chart? Here you can see price impulsively moving to the upside as buyers aggressively keep pushing price to the upside, until they find enough supply to fulfill their demand to rebalance price. Likewise here you can see aggressive sellers putting in hard selling pressure, liquidating all of these bids, pushing price lower and lower until they've consumed enough demand to fulfill their supply. This is ultimately the algorithm of how the markets move. When there's an overwhelming imbalance between supply and demand, price will keep seeking liquidity to rebalance price, and this is happening every single second that the markets are open. Now obviously you and I aren't trading big enough at the size of these institutions to completely liquidate price. So how do we make sure that we trade on the right side of the order flow of price? And that's where supply and demand zones come into play. Now, how exactly do we identify these supply and demand zones on our candlestick chart? When price is moving sideways in a range, this is where orders are being accumulated and where institutions are accumulating and distributing price. As price moves into the bottom half of the range, this is where buyers step in. Ultimately, they are there to buy price at the most discounted and cheapest price possible. As price moves into the top half of the range is where institutions are looking to sell price at the most premium and expensive prices possible. The whole technique of this is to buy low and sell high. Pretty simple, right? Eventually, aggressive buyers will create an overwhelming imbalance between supply and demand, creating a rapid movement to the upside, breaking outside of this range, to search for more liquidity to absorb the demand. And this is what creates those demand zones. Now, we don't trade the initial breakout because this is where losing traders FOMO into long positions. Instead, we wait for price to return to this previous demand level. And then we look for our entry models to get long. And this is where the risk to reward will be on our side and we're buying where the institutions will be buying. Now, why does price return to the zone and continue from there? Well, at this particular level, there is not enough demand to keep pushing price higher. So we wait for price to return to this previous area of demand zone because institutions will have invested their interest into this area and they keep their initial long positions in profit. And it's also likely that not all of the orders have been fulfilled when this demand zone formed, so price could be pulling back to fulfill any uncollected and any unfilled orders. So therefore they would want to get long with their remaining orders at these discounted prices. Because remember, the institutions are going to want to buy as cheaply as possible. Now there are other one or two theories, but we're not going to dive into that in today's video. Now, the exact opposite happens when price forms a supply zone. Sellers will be in a range, busy selling price at the most expensive premium prices as possible. Demand and buyers buying price at the cheapest price possible, where institutions are busy accumulating and distributing price. Now, when sellers create a large imbalance between supply and demand, they will create that huge push to the downside. But again, we will wait for price to pull back for that supply zone to continue with the initial move, where institutions again may fulfill any uncollected orders. And this consists of a 4-step process. We have the range, the initiation, the mitigation, and the continuation. And it's this continuation that we are looking to get involved in and short with the institutions. Vice versa for institutions buying in a market, allowing us to keep in line with the institutional order flow. And this is essentially the rhythm and the heartbeat of the market, where the order flow will continue in one direction until there's an overwhelming imbalance between supply and demand in the opposite direction. Price is constantly seeking liquidity to rebalance price. So here you can see price rapidly initiates itself out of the range to the upside, creating a demand zone. And it's likely that this was backed by institutional involvement. Price then pulls back to mitigate the supply zone, where we can look to get long to capture continuations. And you can see the sustained bullish order flow as demand is clearly now in control. Remember, the markets don't move in one direction forever. It will eventually get to the point where price reaches high enough in premium and expensive areas of pricing, where supply starts to take over. Then we start to see the sustained consistency of bearish order flow to keep their running positions in profit. The highest probability trades will always happen in line with order flow, so don't bother trying to fight against it. So how do we mechanically draw these supply and demand zones in the same way every single time on our candlestick charts? There are three types of supply and demand zones. The first ones are the ones I recommend you use: a range and a pivot zone. The names are pretty self-explanatory. A range zone is formed where price clearly initiates itself out of a range with a candle body closure, and you can then draw the zone from the top to the bottom of that range. A pivot zone is a pivot in price caused by only one or two candles. You can draw this on the single candle, or you can include the second candle as well. Now, in a pivot, supply zone is usually a bullish candle before the big thrust to the downside, closing below that opposite side bullish candle. This can be called a buy to sell zone. And a pivot demand is usually an opposite side bearish candle where the next thrust candle closes candle body closure above that candle. Personally, I'm not too fussed or strict on a buy to sell or a sell to buy zone, because sometimes I will draw a bullish candle as the demand zone when the next candle creates that hard thrust to the upside. Vice versa with supply zones, because I'm really just looking for that pivot zone that creates that large thrust of imbalance between supply and demand. For a demand zone, that thrust candle must close above that demand zone, and vice versa for supply. That supply zone, the next candle must create that candle body closure with that large thrust below that supply zone. And you can see how a range zone can be refined to a pivot zone, which can be refined to a fractal zone, being just the wick. However, more refinement can lead to tighter accuracy, tighter stop loss, ultimately giving you that tighter risk to reward. But it also increases the probability of missed trades, as price might not tag you into the position once enough orders have been fulfilled in the entire range or pivot zone, missing the fractal zone. Find a consistent balance that works for you and stick to it so that your edge can play out in the long run. You know, don't be chopping and changing just because you feel like it. I recommend, if you're just starting out, always start off by taking the single candle pivot, as this gives the best balance between risk to reward and also getting tagged into your trades. Now remember, the market is made up of all of those orders transacting with each other, but we visually make sense of that through our candlestick charts. If you see a range created zone on one time frame, let's use the example of a 1 hour chart. On that 4 hour time frame, that 1 hour range zone will become a 4 hour pivot zone. Because if that 1 hour range zone consists of 4 candles, those 4 candles would be equivalent to 4 hours. Therefore, on the 4 hour chart, that range will then become a single pivot 4 hour candle. So when you truly understand the fractal nature of the markets, you don't even need to be jumping around between time frames, because you will automatically be able to visualize what price would look like on that higher time frame. And this is why a lower time frame range will be a higher time frame pivot zone, and vice versa. A higher time frame pivot zone will be a lower time frame range. Here are 3 types of fractal supply and demand zones. First is an inside bar. This is where a candle fails to break the previous candle's high or low, and it trades inside of it. Inside bars are ranges on a lower time frame. The second type of a fractal zone is a sell to buy wick or a buy to sell wick. For a STB wick zone, when price is bullish and we're moving to the upside, it looks like there isn't a demand zone because price does not form a pullback on that specific time frame, but those wicks represent a pullback on a lower time frame. As you can see, price moves to the upside, then pulls back as the next candle continues to the upside. And the exact opposite happens for buy to sell wick zones, where price is moving aggressively in a downward direction. These wick pullbacks would represent a lower time frame pivot or range zone. The third type of fractal zone is the large wick of the pivot zone. So if the pivot zone forms a large wick, you can mark out just the wick of that zone rather than the entire candle, as this will be a lower time frame pivot or range zone. Now, as much as those are just simply fractal refinements, they are really just a way of looking at lower time frame zones on your current time frame. I would suggest ignore this for now and primarily put your focus in the pivot and range zones on the same time frame that you're looking at, because those will contain the most orders and therefore should give you those high probability moves. Now, not all supply and demand zones are created equal. There are very specific criteria that must be met to make that specific supply and demand zone a high probability institutional level. There are 8 key points to focus on that makes the difference between a supply or demand zone and an institutional supply or demand zone. And the first is whether the zone led to a break of structure. This is the simplest and the most effective filter that you can use. It takes a ton of money to break structure on a liquid instrument, and the more significant the structure it breaks, the more significant the zone. Swing structure is stronger than internal, which is stronger than fractal. Zones that create the swing break of structure are the zones that are going to be the highest probability to give you the best moves, because those are where the majority of the orders lie. To continue with price to create that next break of structure. Here you can see this demand zone broke the previous daily swing high. So price would return to this demand zone to fulfill the orders within this demand to break the next swing high. Number 2 is a flip zone. Now the key here, you must see that interaction between supply and demand until one overpowers the other. So here you can see supply was in control where price tries to make another lower low, but it fails to do its job and huge demand steps into the market. That pattern that is being represented to us on our candlestick chart is now showing that demand is now taking over control. And this is a high probability area for us to get long. But remember, it's super important that you see that interaction first between supply and demand until one fails the other. That is so important to make a flip zone valid. Number 3 are sweep zones. These are zones where liquidity has been swept and liquidity is taken as the supply or demand zone is created. But why is this significant or relative? Because remember, institutions need opposing liquidity to trade against so that they can get minimal slippage when they enter and exit the market. When they're buying, they need a lot of supply to buy against. So therefore there would be a lot of sell orders below these equal lows that's generated from people's stop losses, FOMO traders trying to get long on the breakout, and the institutions know this and they will use that sell side liquidity behind these equal lows in order to get long. So if you see a sweep zone, this signals it was created with institutional involvement. Number 4 is inducement, and this is another liquidity concept that can get quite technical, but let's keep it as simple as possible. Essentially, all you want to see is there available liquidity in front or behind a zone. Why? Well, same reason as before. Institutions will need opposing liquidity to enter the market with as little slippage as possible. Here you can see there is available liquidity behind this low for the institutions to use to buy against, because if there isn't any available liquidity, it is very often that these zones will fail. Here you can see there is absolutely no available liquidity in the leg, and this is a very obvious trap where institutions will not be selling from. Number 5. Is the current time frame zone stacked with a higher time frame zone? The more zones that you can stack across multiple time frames, the more orders will be resting in that zone, increasing the probability of the move from that zone. Number 6 is, do you have the higher time frame alignment? Because the more time frames that you have aligned, the higher the probability of that trade. Here what might look like a beautiful sell opportunity in a bearish 5-minute market and bearish 5-minute order flow to follow that bearish trend on the M5 time frame. But the higher time frame M15 is bullish and it's just mitigated the higher time frame M15 demand. At the strong M15 low, where we can expect the M15 now to create that next break of structure to the upside. So therefore, it is likely that the M5 will also switch bullish. Understanding multi-time frame analysis will help you eliminate many losses, as time is power and the higher time frame will usually win. Number 7 is the zone well priced. Generally, the highest probability demand zones will be buying in discounted cheap areas of pricing, and vice versa with supply. Generally, supply will be selling in expensive premium areas of pricing, where the discount is in the bottom 50% of the range and the premium is in the top 50% of that range. This also improves your risk to reward because we want to buy low and we want to sell high. Last but not least is the zone unmitigated, which is just a fancy word as has that zone been tapped before or has orders already been fulfilled in that zone. Another way of saying, is that zone completely fresh or has that zone been touched before? So here you can see in this example, this zone has been tapped into multiple times before, which now is very likely that all of the resting orders in the zone has already been collecting, increasing and making the probability very high that the zone will fail. So therefore, I usually like to focus on the zones that are completely fresh because these usually give you the strongest moves. Now, combining all of these factors together are going to give you the highest probability supply and demand zones to trade from. Now that you know how to identify these high probability zones, how do you actually trade from them? There are countless ways, but here are 3 main methods. The first one is just simply setting a direct limit on that zone. The second is using a reversal candlestick formation after price has mitigated the zone, and this is best combined after a liquidity sweep. And finally, you can use a lower time frame break of structure inside of that higher time frame demand or supply for more confirmation and increased risk to reward. But don't worry, I will cover entry models far more in depth in a later video. So make sure that you subscribe with the bell on so that you don't miss a notification for those videos. Now, before you even enter a trade, you should know exactly where and how you're going to enter and how you're going to exit. And there is a whole series on just trade management alone. But my recommendation, if you want to get consistently profitable as quick as possible, is to use the fixed R method. So this is where you always target the same amounts, such as this, for example, a 3 risk to reward. It's a set and forget approach that helps to keep the emotions very low, as you're not chopping and changing between technical targets. At the end of the day, trading is a probability game, and the fixed R method just helps the numbers in your favor. Now, watch this playlist over here, which will give you my entire free mentorship, which will give you a full walkthrough on my technical analysis on how I approach the charts every single morning, understanding the orders and supply and demand in the market. And you can also watch this video over here that will go over accumulation, manipulation, and distribution. Take care, guys. I'll see you in the next video.